Pratik Gupta, CEO and co-head Kotak Institutional Equity joins us now. Pratik, what is your view on the way how markets are set up, and do you think we are reaching what could be called as peak of good news?
Hi, Nikunj. I'm not sure we are at the peak of good news as yet, because frankly, there is still plenty to come in terms of things like, the earnings environment is still actually very weak. So we can't call it good news. The management commentary across the board is by and large still somewhat weakish to at best neutral in most cases. So we still are not really in a good news environment. The good news would be when, I guess, earnings really start delivering and you start seeing, good earnings growth coming through. At Kotak, we are expecting the Nifty earnings growth to be just about 10% in the current year. We've seen a series of downgrades in the last few weeks and over the earnings season. The good news is definitely in terms of, I guess, tariffs and geopolitics. They're definitely, there's a lot of optimism that things have settled down and the worst is over. But what definitely, I think, in our view, investors globally are still very worried about a sharp global slowdown. Just the uncertainty caused by the tariff environment, that itself will create issues in terms of economic growth globally, which in turn, as far as India is concerned, that impacts us relatively less, which explains why a lot of foreigners are still interested in India. But nonetheless, our exports will get impacted, the merchandise trade exports and slowing global economy, that hits us. On the flip side, we do benefit from lower oil prices, lower commodity prices. So that's helping, for example, a lot of our consumer companies or the companies where, oil and oil derivatives are an input cost. So we've seen, some benefit to margins. But generally, we think, there are still many more things to look out for. For example, the RBI's liquidity support, the lower interest rate environment. Hopefully, we'll have a good monsoon. We're hoping that in the next few quarters, finally, the consumption slowdown that we've been seeing post-monsoon, that should start picking up. The capex cycle has been frankly dead, the private capex cycle, so that should pick up. And I think two very important factors. One is all of last year, we've seen a slowdown in government capex or slowdown in the growth rate in government capex. That hopefully will start picking up after the monsoons. We've got a new bunch of finance ministry bureaucrats who are at the helm, and hopefully they'll drive things a bit more. And second is the regulatory environment. You've got new regulators at the RBI, SEBI, and likely at the IRDA as well. And generally, the mantra seems to be make it easier to do business, reduce compliance cost. All the players were sort of suffering. So to that extent, that also helps. The fly in the ointment is, of course, valuations. That, unfortunately, we still trade at very expensive valuations. So that's the thing that's, holding markets, that's keeping investors away to some extent.
Pratik, so what could be the next big trigger, as we say?
There's nothing visible as such. One trigger I could think of is potentially, for example, on Friday, we saw India's sovereign rating upgrade by Morningstar. Now, that's a relatively one of the smaller rating agencies, but you start seeing perhaps 6 to 9 months later, some of the bigger guys like S&P and Moody's upgrading India. That could lead to a lot more, that's a very big positive as and when that happens. Otherwise, you have to literally wait for the private capex cycle to pick up, which frankly was being held back because of uncertainties on either politics last year, domestic politics, or tariffs, or geopolitics, whether you'll see China dumping and so on. And that's been sort of held back last, I would say 3-4 quarters. That's been slowing down. So as and when that picks up again, as businessmen get confidence, then you'll start seeing a recovery. But otherwise, no such any single big thing which I can think of offhand.
Okay.
All right, Pratik.
Sorry, just to add just one.
Yes, please go ahead.
Yeah, sorry, just one more thing. The big thing to look out for is in our conversations with global investors. As you know, emerging markets as an asset class has underperformed the US in particular for the last 10, 15 years. And finally, I think the weakening of the US dollar and a crack in the US equity bubble, especially the tech mega caps in the US, we are beginning to see some incremental investments being made away from the US. And we're seeing this helping, especially some of the European markets, the Hong Kong, China markets, and even India. You've seen the last few weeks, with the exception of Friday when we had geopolitical concerns. India has also benefited, through some FII inflows. So as we progress in the year, the next big thing could perhaps be a renewal in emerging market flows. The timing of that is very difficult to predict, whether it happens 3 months later, 6 months later, 9 months later. But EM as an asset class has underperformed for so long. Most people have forgotten about the back in the mid 2000s when EMs were seeing very strong inflows. So that could be something to watch for, but tough to put a timeline to it.
Pratik, just to understand the dynamics of the banking sector, banks are going up because FIs are back, or banks are going up because the economy is moving up, or banks are going up because they are cheap?
A bit of all three, actually. In a relative context, the banks are still relatively cheaper or less expensive compared to, let's say, IT services, where frankly you have a very high earnings risk. You've seen a lot of earnings downgrades over there, or versus, let's say, the consumer sector, where generally you're just seeing single-digit volume growth, and companies are reporting earnings only on the back of they got lucky on raw material prices, or they've managed to squeeze their marketing and advertising expenses, or they've cut employee costs. So the entire consumer pack looks somewhat expensive. Or if you look at the capex plays, likewise, not much capex happening. Barring one or two odd companies, the ordering cycle is still quite weak. So therefore, banks relatively look far more attractive. Second, yes, FIs are coming back and have been coming back, and for them, banks are the large liquid players on the economy. So that's two. And third, from an earnings perspective, there'll still be, low mid-teens kind of earnings growth, which is okay. It's not great, but it's in the context of the overall market, it's still a decent growth. And also, you get these are large liquid names for FIIs to come into.
Pratik, sectorally, where do you see the money flowing in, and where is the most interest that you are catching from the investors? Because, well, of course, there are a lot of sectors that are getting a bump up, case in point being the IT, the metal pack, they are shining bright.
So for IT and metals, we actually have a somewhat of a cautious view. IT more because of the US slowdown, and longer term, the AI risk. But more importantly, the valuations, even the large cap ITs, which are still within the IT pack, would prefer the large cap IT companies. But even they are trading at 22 to 25 times earnings, where for the next 1 or 2 years, you'd probably see single digit earnings growth at best. Now, these are high ROE, ROC companies, strong free cash flow, so they deserve a premium, but nonetheless becoming more like utility companies in the short term with not much growth. The mid-cap IT companies are trading far more expensive valuations, 35 to 45 times 1 year forward. Stronger growth, but then again, expensive. With the metal companies, again, because of the global slowdown, we think demand will be impacted. There's still a lot of oversupply, especially in steel. We prefer aluminium over there. So where we are seeing interest is still the financial services. The one is the banks, which I just talked about. Second is the NBFCs, especially given the RBI's push to ease liquidity, bring interest rates down. That is definitely reviving interest in NBFCs. We actually like also the smaller affordable housing finance companies, which there was a lot of concern on asset quality, but they've actually held firm, on the asset quality front. Insurance, life insurance in particular, is one area where we're seeing a lot of interest, again, in the context of valuations in the rest of the market and somewhat steady growth prospects over here, and prospects of an easier regulatory environment. There have been indications that even the constraints on using bank assurance as a distribution channel, that those will likely be eased. So life insurance, then things like telecom and to some extent domestic pharma. One area which I would like to highlight, which is seeing interest, something which we are recommending, are the REITs. in a sort of expensive market environment where earnings growth is still weak, a lot of investors are looking at REITs as well. These are, they give you 6, 7, 8% dividend yield plus you have growth. So you end up getting about 9, 10, 11% sort of overall return, which is not bad in an environment like this when the overall market upside is somewhat limited.
Okay. Now, why do you think market upside is limited? Because earnings will not grow, P multiples will not expand. Why do you think its upside is limited?
Well, this is more from a short-term perspective, meaning the next 6 to 9 months, mainly because of the valuations. We're trading at, firstly, earnings growth. Earnings growth this year, like I said, for the Nifty, if you take as an example, 10, 11% earnings growth this year, 14, 15% earnings growth next year. Second, valuations, we're trading at almost 21 and a half times March 26, about 19 times March 27. Interest rates have already come down, and more importantly, the markets are already pricing in further rate cuts. From a liquidity perspective, domestic liquidity remains strong. FIs are back, but we don't know that is the only thing which I said, the one big thing. We could see FIs coming back in a much bigger way later in the year, but barring that, tough to see the market re-rating upwards. And as far as earnings are concerned, we are still seeing earnings cuts, and frankly, after the June quarter, you might see another round of earnings cuts.
Well, Pratik, always appreciate your time. Thank you so very much for joining us, and look forward to see much more of you going forward.
Thank you.